I'm doing well. There's Austin too from Houston.
Oh, nice of the host to join us.
What is up? How we doing?
We're
Oh, we're
here.
just chit-chatting before you got in. You'll see it on the recording, I guess.
Good. Good. All right. Well, let's get started. It's time. It's 12:30. I was debating whether or not I should wear a hat like you or if I
I was
should
just because I need a haircut, so that's why I'm wearing a hat.
I feel that. I feel that. How you doing today, Albert?
I'm doing good. I love Mondays. I think I've probably said that multiple times on these calls. It's just a fresh week, fresh start, get some stuff knocked out, and ready to go.
I love Mondays too. I've always loved Mondays. It's the day of opportunity. It's like the New Year's Day of the week. It's like a it's like a great day to revisit your goals and to reevaluate the things that we're going to accomplish in the week. So got some big stuff happening. So we are at the end of our funding series. It's pretty interesting. We talked about hard money, private money. Next week we'll get back to evaluating a deal. So if you're on the call or you're watching this later on in the week on YouTube and you have a deal or two or three that you want us to take a look at, we'll break it down. And Albert and we often see eye to eye, but not always, and we don't always have to agree. And it's good to have different perspectives when it comes to different deals and properties. And so
Hmm.
so what's new in your world? What have you accomplished in the last 7 days since we last met?
Um, let's see. We secured some private lending financing for one of our projects. That's going to be kicking off here in the next week. Hired a social media manager to do some social media for me, just on a really small scale for now, just getting started with that. So that's kind of cool,
What
or at
it,
least hired him for a few jobs, for a few
okay, so
things.
what does that look like on the so
Really,
having
just
someone
capturing content, and creating content. Something that I can do, but he's professional at it, so I'm just trying it out right now just to see how that goes. So
sounds good.
nothing on a
Sounds
large
good.
scale, but it could be on a larger scale later. But yeah, so did that. Let's see, what else did we do in the past week? Real estate related. Other than that, hung out with a bunch of friends over the weekend. Saw like they have college kids going to and from college, so that was pretty cool too this weekend. So that was some good family time with friends.
Very nice. Excellent. Well, we're definitely seeing a pickup in contracts and a pickup in traffic. There's been more interest in what's going on. So we actually put two properties under contract that were off market, which that hasn't really been happening um,
Awesome.
very much. So good stuff. We do have a special guest with us, so we're going to be talking about uh, DSCR loans and SBA loans, a different type of financing options that may be available to us. But I have a good friend with us. His name is Magdiel Garza. He's with South Trust Bank. Magdiel, say hi. How are you doing today, sir? Appreciate you
I'm
jumping on.
great. I'm great. Thanks for having me. I echo that sentiment. Mondays is the kind of the reset day. It's a day of optimism, so I'm optimistic. Got some loans approved this morning, so it's been a good one already.
Congratulations. Are you seeing a pickup in applications right now?
Surprisingly, yes. Just kind of late last week into today, I'm already getting a couple more calls, a little more. It's like people are waking up from summer, I guess, or getting back from
Yeah,
vacation, and
yeah.
school's gearing back up. And I'm pretty optimistic that August is going to be kind of the pickup to the second half of the year and start to look a little better.
What type of products are you seeing investors or buyers in general? Like what's keeping you busy? What type of products are keeping you on your toes right now?
Well, a couple of things. For me personally, I've got a lot of kind of folks that are renting and they're now looking to buy the building. Either they've been in or they've outgrown the space and they're looking to kind of purchase another building, something like that. I am getting some refinances in because a lot of these folks that secured these great rates, they were like on a 5-year note, and so
Hmm.
unfortunately, across the board rates have gone up, as all of you guys know. So, uh, you know, reluctantly they're having to refinance, but we're able to kind of help at least soften the landing there a little bit.
Yeah.
So those are kind of the things I'm looking at. Got a couple of apartment complexes that I am looking at. Unfortunately, some of those haven't come to fruition just because of the
Those
price
are
point that they're at.
those are tough right now, aren't they?
Those are tough. Yeah, I just think unfortunately the sellers uh just are still a little overpriced. Maybe that's out of necessity because of what they owe on it or whatever it may be, but
Yeah.
it's tough to make the cash flow.
So in regards to new buildings, you're seeing more
Owner
owner
occupied,
operated,
yeah.
owner occupied. Okay.
Yeah,
So
yeah.
small businesses occupying. Are you seeing a lot of smaller businesses buying multi tenant retail? Like, we may talk
Yeah.
about the SBA loans, or you're seeing that where they will occupy part of it and lease out the other part of it.
Yeah, yeah, absolutely. So in our world, as long as it's occupied more than 51%, it's considered owner occupied. So if they occupy 51%, lease out the rest, they can do that and it's still considered owner occupied. The reason that's important is because you actually get a better rate when it's owner occupied. They consider it a bit more of a safe bet, if you will.
Right.
And so, and you're actually able to get in with a lower down payment. So we offer a higher loan to value, financing option for that. So as an example, if it's an owner occupied piece of real estate you're buying, we can finance up to 80% of it here. Whereas if it's considered investment, we can only do up to about 75%. So
That's so you're bringing up something interesting because we've discussed house hacking. So like on the residential side, obviously your home that you homestead, you're going to get a homestead exemption. You're going to get a better rate, with the house you live in. And as an investor, your second and subsequent investment properties, you're not going to get the same rates. You're definitely not going to get a homestead exemption. So what you're saying is basically a very similar principle that's applied in the commercial world. So for somebody like, for instance, one of my businesses, my first successful business was music school, and I still own that music school. A business like that could probably take advantage of some benefits and some opportunities by occupying that building. This is not just, correct me if I'm wrong, this is not just SBA lending we're talking
correct.
about. We're talking about in general, an owner occupier is going to generally get a better rate,
Mhm.
require less down payment, right? So,
Absolutely. Yeah, you're correct in saying that.
so you're hitting on house hacking commercial style, like commercial uh, property hacking, where a small business, like if you own a small business, there's some really good opportunities for small businesses to leverage their business as a way to grow their real estate portfolio, right?
Yeah, yeah, absolutely. And I can tell you for most of your folks that bank with maybe bigger banks like your Chase, your Wells, or any of those, they a lot of times won't even look at a deal if it's considered investment real estate or what they call income producing, right? And so really the only way to obtain that property at a bigger bank is going to be to say, I'm occupying it at 51%. Smaller banks like mine, your regional, your community banks, they're more open to doing
Right.
more income producing. Yeah. Hmm.
Okay, awesome, awesome. So one thing that we want to get in specifically today, while we have you on the call, is DSCR loans. I think that's a product that's probably applicable to what a lot of people want to do in the commercial space. But can you talk to us a little bit about what that stands for and what that means a little bit?
Yeah, yeah, absolutely. So for us, DSCR, well, the acronym is debt service coverage ratio. So your typical bank is going to ask for a 1.25%, 1.25 times debt service coverage ratio. And what that essentially means, just kind of in layman's terms, is for every dollar you're looking to borrow, they're wanting to make sure that that property is cash flowing $1.25 out of it. And
Perfect.
that's after your NOI, right? And so it's
Mm.
after everything's been accounted for. Um, and you know, the way we just basically, back into that number, like I said, we take the NOI and then we take what your annual payments are going to be. And so we divide that number, and that's how we come up with the debt service coverage ratio. And a couple of things can happen. So, for example, right now, if I'm looking at someone brings me a deal and you, let's say multifamily, and I'm looking at it and it doesn't quite get there. Let's say it's at a 1 to 1. So for every dollar you're looking to borrow, it's breaking even, if you will. We're going to rely pretty heavily on the guarantors. So if the property does not cash flow at a 1.25 DSCR, then we're going to look to see if times get tough, if there's a lot of vacancy, if there's just some, they're having to replace the roof or whatever it may be. Do they have the wherewithal to make those payments and continue on if if some headwinds come about? And so that's essentially that kind of determines on whether we can do the deal or not. If the answer is no, they aren't that strong, then we're very heavily reliant on that 1.25.
Okay.
Obviously, the higher the better.
So if that property doesn't hit that 1.25, um, it doesn't qualify for a DSCR. What is the alternative at that point?
Yeah, so the alternative really is just they either put more money down in on the deal or the price comes down. Really, those
Okay.
are unfortunately the only two. Now, the I guess the third alternative would be if someone has a free and clear property, let's say a rental home, something like that. We can take that as additional collateral. Now the loan to value and now the essentially what we're doing is we're taking cash out of that property and applying it toward the down payment, if you will. That's kind of the way we look at it. And so that's another workaround. Um, so we can get a little creative, but it all depends on, on the strength of the borrower, essentially.
So this is plan A is is what it sounds like, the DSCR product when it comes
Right.
to buying. And I mean, what asset types are we looking at? Are we talking about? We're talking about multifamily, retail.
Yeah. So we can do, for that a DSCR loan, we're looking at multifamily, we're looking at, strip center,
Hmm.
really anything with income producing. We can even, that's even the same case if you're looking to buy a portfolio of homes, portfolio of rental homes, things like
Okay.
that. So anything income producing, we'd look at it the same way.
Okay. And so,
Hmm.
how long has this always been like the standard, like the the best first option for investors? Is this something that's changed over the years? And the reason why I ask, and Alberto, feel free to chime in, but we have a relationship with a lot of property owners that own multifamily, even hospitality, retail, and they didn't do these types of loans. Their loans were way more traditional from what I understand. They were more based on, like you said, the guarantor, their cash on hand, their debt to service, the same, similar to the same criteria that you would qualify somebody buying a house. Am I
Hmm.
am I right? Is this something that shifted at some point?
I don't, as far as I know, I don't think it's shifted. I think more than shifted, it's, um, could be a couple of things. It could be that they maybe, do you know if they were less than 4 units? They might have gone through a more traditional mortgage broker. That could be
No,
one.
these would have been commercial
Okay.
uh,
Okay.
loans.
Commercial. Yeah. I will say, well, no, yeah, you're right. It could be that with this new environment, yeah. So even in the, I don't know, 5 years that I've been at the bank that I'm at, when we first started, let's say something didn't cash flow on its own, we could go back and pretty easily make an assumption that by them raising the rents, by them filling it up over the next year or so, they maybe managing it better, doing some things that maybe the rents would go up and we can make
Hmm.
it work. Now, no, they want to see it cash flow. Most banks are going to want to see it cash flow at a 1.25 at least,
Hmm.
right up front. Yeah, yeah. So that may just be the environment that we're in. Could be the main reason that's shifted. But yeah, you're right in saying that it has shifted.
I think that's
Yeah.
it's important. Go ahead, Albert.
Yeah, no, I was just gonna add, back when we were refinancing things in 2022, when we were making a lot of purchases in 2021, rehabbing properties, we used DSCR loans for single family as well,
Hmm.
from 1 to 4. And
Mhm.
so, and then back then the rules were a little bit less tight, less strict, So like some of the products we were looking at were at zero point 0.8 DSCR.
Oh wow. Hmm.
Yeah, up to 1.0 and then 1.1. I think 1.1 at the time was kind of the highest back then. And then, like you said, if the rents, or because they would do a rental like comparative market analysis,
Hmm.
Hmm.
and if the rents weren't quite where they needed to be, you would just cash out less, right? So basically just getting less back, or maybe having to bring some money to closing. But that's what we've used DSCR with all of our refinances on the single family side too. So
Hmm. Hmm.
yeah, and it
So
works
that's your
pretty good,
that's your strategy to use those DSCRs on the
That's our
more
strategy. Yeah.
on the
So we'll
refi.
get in, like we talked about before, we'll get in with hard money or private money. And then if it's a rental property that we're either selling, or if it's a flip that we couldn't sell and we have to refinance, we're DSCR's our go-to, at that point.
So
Yeah.
let's talk about the pros and the cons of the DSCR. So you mentioned one um, that the DSCR is going to look more at the asset rather than the borrower,
Hmm.
right?
That's plan A. Yeah, that's the primary thing they look at. Yep.
You also
Yeah.
talked about the approval process. Seems to be it should be faster because as long as the property owner and this is we have a message for real estate owners here in a second, but as long as the property owner has healthy financials that are easy to interpret,
Hmm. Hmm.
it can go faster. Is that right?
Mhm.
Yeah, yeah. I mean, essentially, we're looking at the latest, the rent rolls, the T12. We're looking at, what are your expenses? Just essentially, if we can really, really get a grasp on the NOI, then it goes a lot smoother. Unfortunately, as you guys know, that's not. As easy as.
Yeah.
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 It's a lot
Sometimes
easier
it's
on the single family side, right? We're just, like I mentioned before, they're just looking at appraisals and
Hmm.
maybe looking at reserves, but not really. And I remember back up, I think our last refinance was in 2023. We were getting 30-day closes. From the
yeah.
time we signed the disclosures to the closing date was 30 days. So
Yeah.
it's pretty quick.
Yeah.
Yeah.
Yeah. That
On
that
the
can
single family
happen.
side, it's pretty quick. Yeah.
Right, right. Yeah, that can happen. It's typically just a lot of how quickly we can get the information that moves things along pretty quickly. Yeah.
Hmm.
So this goes back to if you're on this call and you're owning properties or buying properties and or you want to maybe one day sell, it's critical to keep good records. It's
Hmm.
critical to keep a monthly profit and loss statement. Keep a balance sheet. We talk about that all the time, but for some reason, a lot of people don't listen when we tell them that. They go to sell and their financials are just uh, chicken scratch on the back of a napkin. So
Hmm.
um, yeah, that's where. So when a property owner maintains good financials, that's what can really facilitate the process, right?
Hmm.
Absolutely.
Any
Yeah.
any other pros of DSCR loans that we need to talk about today?
I mean,
Uh,
I do like the fact too, again, I'm coming from the single family side and we mentioned this before, because we were saying asset, like they're looking at the asset. So what that really means is they're not looking at that borrower's W-2s.
Right.
And then that also kind of makes that approval process go faster.
Yeah,
Yeah. So
that's
I think
good.
it's like one of the good pros for us that are,
yeah.
that are full-time real estate investors. Yeah.
Yeah. No, you're absolutely right. If the deal cash flows on its own, that typically you're 80% there.
Mhm.
Usually we'll move on to the next thing. But it's when it doesn't cash flow when we do that. That's when we are requiring financials from the guarantor
Gotcha.
to see if they can back up the strength.
Oh yeah.
Got it.
Yeah. Mm-hmm.
So
Mm-hmm.
what are the cons? What are some of the cons? when it comes to
Um, you
DSCR
know,
loans?
really the only con I can see would be just, if right now in this environment, it's it's a little tough to find deals that are really cash flowing.
Yeah.
And so not to sound pessimistic or anything, but it's just that's been the challenge that I've seen. If we can find one that cash flows and we're there, then we can get it done. Or the alternative is if you really like the deal, you know that there's potential for growth there, that it's a market that's on its way up, then you can just maybe put a little more equity into the deal to make it cash flow. Then
Right.
once things kind of loosen up, rates drop, we can always refinance it, and you'd be in a better cash flow situation then.
So the down payment, what does that usually look like with DSCR loans?
Typically on a DSCR loan, it's 75% loan to value, so it's 25% down is what we're
Got it.
looking.
Got
Yeah.
it. Got it. And what are you seeing as far as interest rates? What can we typically expect
Yeah,
there?
for something like that, right now we're at about 7.5 to 8, somewhere in there, depending on the strength of the deal. High end would be 8, low end probably about 7.5.
So would you say like typically about almost 1 percentage point higher than like your conventional loan?
Well, honestly, for us, it'd be about half a point higher. It
Half a
because
point.
our conventional, well, I say conventional, but yeah, if you're looking for owner occupied things like that, we can probably drop it about half a point. But it's not much in the way. It's not much of a difference, to be
Okay.
honest.
Okay.
Hmm.
Okay.
Hmm.
Any other limitations or I mean, we're
Yeah.
talking about, go ahead.
Uh, no. Sorry to interrupt there. Yeah. The other thing I think of is just we prior management experience goes a long way. So if you've
Hmm.
done either flips or
Yeah.
you have a portfolio, that goes a long way for us. We It's a little difficult to get it done when it's your first purchase, if you will.
Yeah.
And then obviously secondary source of income helps a lot. Whether that be your full-time investor, you own your own business, you W-2, any of that, if we can show another source of repayment, just in case, again, things go south on this one particular investment, that makes the bank feel a lot better. It's not the end all be all, but it definitely helps the deal.
I
Right.
think that
And then you
the
have,
key thing you hit on is that it's got to be cash flowing going into the
Hmm.
deal.
yeah,
Right.
I think prepayment penalties too can kind of sneak up on people if rates do go down, tend to go down within that period, you might have to
Hmm.
wait, or you just kind of look at the numbers and see if it makes sense to refinance and pay that prepayment penalty, which you don't typically have those on the conventional side. Um, so
That's a great point. That's a great point. Yeah, our prepayment penalties typically are 3% the first year, 3% second year, and then they step down to 2% all the way up to 5 years. If you're in your fifth year, you'd be looking at a 1% of prepayment. So it's kind of a step down method. Hmm.
this is a question from my side, at least for on the DSCR loans, those are typically longer term loans too, right? There's not like a short term balloon payment in like 5 or 10 years, or is that also part of that too?
Yeah, so it's typically we'll do depending on the property, but typically we'll do a 10-year term with a 20-year amortization schedule.
Mm, okay.
But
Mm.
the first 5 years have the prepayment penalty with a
Mm,
fixed rate. So after 5 years, you're welcome to go shop the market and see if there's better rates. We'll always try to keep you, so we'll make sure that we're competitive. And if you tell me, hey, I got a better rate down the street, I may be able to match it. But after the 5 years, there's nothing holding you really to
Hmm.
us because there's no prepayment. So,
No, that's
but
fantastic.
yeah, we'd ask that you stay for the 5 years without any prepayment. I mean, I'm sorry, with a prepayment. Yeah.
Got it. Got it. No, that
right,
makes sense.
with a balloon at the 10 years, right?
Correct. The balloon at the 10. Yep.
I got
Yep.
you.
Yep.
Okay.
And 20-year AM. 20-year really is the most that we'll do on
On the
amortizations.
commercial side.
On the commercial side. Yep. Yep.
And
Yeah.
is
Yeah.
it, yeah, that's good. So who are some of your like ideal clients? Like who needs to know about these deals? Like who's not taking advantage of DSCR loans that really needs to talk to you about them?
Well, to me, any investor who is, looking for their next project, that's really who I want to be talking to. Like I said, if it's your first time, and maybe you don't have that amount down or you don't really have a lot of cash reserves, things like that, that may be more, kind of the conventional. But for me, it's an experienced investor who's looking to, to get their next deal, their multifamily, their strip center,
Mhm.
um, things like that. I'd be more than happy to talk to them. And as you know, Austin, it's always with me. I've been doing this for so long. If I can't help you, I'm going to find somebody that
Yeah.
can for you, So, yeah.
Magdiel, tell us about some of the other products so you talked about owner occupied financing, um, which is not a DSCR loan. Am I correct? DSCR loans are not used for owner occupiers. Am I understanding that correctly?
That's correct. With owner occupied, we're looking at the operating company. So, for example, you're a machine shop, you're wanting to buy your own business. You're obviously not going to be getting any income from the property. So, we look at your financials, your P&L, your balance sheet, your tax
Hmm.
returns to see how much money you're bringing in. So, the operating company is the one guaranteeing it. So, that's more of a cash flow loan, a conventional loan, if you will. Um, but yeah, so types of loans that I'm doing, I mean, I do a lot of different things. I do, I helped a client buy a boat for his business a while back. It was a tugboat, the
Hmm.
offshore business. I've got a customer with refrigerated trucks. It's a produce company. I'm able to help them.
Hmm.
I'm financing a church right now. They're buying their
Okay.
building. Yeah, over in the Pasadena area. So, we can help with a variety of things. Just reach out. The great thing about a smaller bank like myself is we're a little more common sense approach to
Hmm.
everything. So if the deal makes sense, we can do it, and if not, we're pretty quick about letting you know what your options are.
Perfect. How can we get in contact with you, Magdiel?
Yeah, so I'm not sure if you are able to give out my information at the end of
Yeah.
this, Austin, but yeah, feel free to. My cell phone number is always where I can be easily reached, so you can call me. I'm a Houston native, been in the banking industry for 25 years now. Have a great relationship with Austin and your team. So, yeah, you can email me, call me. I'm available anytime. My office is here in Houston, in the west part of Houston. But as Austin knows, I'm all over Houston, so wherever the business takes me.
We'll see you at our next happy hour. We'll appreciate you coming on and enlightening us about DSCR loans. I know Albert's had a lot of success in this field as well. So it's a very important product for people to understand. So definitely appreciate you visiting
Yeah,
with us today.
absolutely. No, I appreciate y'all's time, and let me know if I can answer any questions for y'all.
We'll do. Okay, we'll stay in touch. And if you're on the call, Magdiel's number is 832-403-8236. I'll leave his information in the show notes, the
Yep.
profile. But yeah, and if you're on the call, feel free to ask questions. The chat is open. You can join in anytime. So
And I have a hard stop at one, Chris. I mean Austin. So I will follow up with you though. Circle back with you later today if that's all right.
perfect. I appreciate
Yep.
it. Yes,
Thank you
sir.
all. All righty.
I may be showing a project today that we'll need your money for. So
Oh, there you go. Yeah, send
yeah.
it over.
All
All
right.
right. Sounds good. Thank you guys.
All right,
Thank
thanks,
you.
Michael.
Bye bye.
So uh, DSCR loans, I think that's pretty simple. I think the magic number there is 1.25. I think that's what people need to. And
Yeah,
you've mainly
and
used these. Go
it
ahead.
on the residential side, Austin, you can shop around as well. I think the residential those lenders that are loaning on the residential side maybe have a little bit more flexibility,
Yeah.
with their underwriting. And like we talked about for the past couple weeks, a lot of this is still relationship based. I feel, even when you're dealing with, a larger bank or like this relationship that you have with Magdiel, right? Is if you're doing multiple deals with this same bank over and over again, they have a board, they have a team, they have people, they have underwriters that they can all meet and talk with. If now you have a deal that's not completely outside of their box, right? But maybe they just have to kind of stretch a little bit to kind of make it
Yeah.
happen. If you're doing multiple deals with a lender like that,
Mhm.
That's why I don't really shop around too much when I find a lender like on the DSCR side. Well, we use the same lender, I think, to refinance 4 or 5 of our properties.
Yeah.
And I it seems like every time we go somewhere else, we have a negative experience. So, it's also important to build relationships on that side too.
That, yeah, the relationship matters, and Magdiel's always, he's always available. He's always easy to get a hold of, and he's willing to do what it takes to solve the problem. And if he can't solve the problem, he admits it really quick, and will refer us to somebody who can. So he got us in contact with Jose Tristan, which is one of our partners that does SBA loans. So we can kind of talk about this a little bit as well, because Magdiel hit a really good point for anybody that's getting into the commercial space. If you own a business, you really need to think about what it looks like to leverage your own business to get into like a bigger retail spot. So obviously that magic number there is 51%. That number does not apply specifically to SBA loans, but it's required for SBA loans. So what I mean is, if you have a business that requires 2,500 square feet of retail space, you can purchase a 5,000 square foot retail space and lease half of that out. So you can lease half of it out, cash flow that, use the income from the rental income from that property to supplement your income. Maybe the business it maybe it just gives your business more breathing room. Maybe the business is giving you an opportunity to expand your real estate portfolio. Um, because we all know this, like we learned this from McDonald's, right? The businesses that are succeeding at a higher level, they're in the real estate business, not the hamburger business, right? So basically, an SBA loan, it's a government-backed loan. And the government wants to give out these loans because they want these businesses to grow. There's SBA 7A, SBA 504. There's different requirements from these. We'll probably need to do another episode where we get somebody on on
Mhm.
this. But if you have a small business, uh, we can get you in contact with one of these guys. In some cases, we've seen 10% down or less than 10% down
Oh, wow.
required to get into certain properties. So I think there's a lot of good opportunities for businesses to get into real estate with very little money down. SBA is the um, route to do that. In addition to this, we have a pretty nice size closing tomorrow. It's on an RV park. Our buyer has a 504 loan, and it's a combination of three things that are closing the deal. So the bank is basically qualifying the loan, um, not not a DSCR loan. This is a qualified on the buyer. So the buyer's qualified for 50% financing from the bank. In addition to that, he's giving 20% down. So 50% from the bank, 20% from the down payment. That other 30%, where's that other 30% coming from? Uncle Sam's from that money right there through a DSCR loan. So it's also a good secondary, and yeah, they're a second lien position
Mm.
as the SBA. So it's a lot of red tape. There's a lot of hurdles we had to go through to get this deal to the closing line. But for this is really, really good for certain underperforming assets like an RV park. Um, it's not going to work for like a multifamily. The reason is a multifamily is not really considered a business as much as it's considered like just real estate. However, the RV park, that can be a resort, so sometimes, when the DSCR loans don't work for like hospitality, maybe SBA may provide some opportunities there. So just some interesting ideas. We're always trying to solve the problem. How do you pay for this stuff? Uh,
So
you
what's
know,
the definition of owner occupied with the RV park? Is it because they own the business
yeah.
or they're actually living there?
The business is the whole thing. The whole thing
So,
is the
so the business
business.
is like, okay, I got you. So it's really the difference is you can't use an SBA loan to, I guess, I mean, if you're using it to fund your business, then that's owner occupied, right? Is that how I'm
Yeah.
understanding it?
Yeah. It's the
Okay,
business. It's funding the business.
I got you. So that's why I guess like a large apartment building wouldn't be considered owner occupied at that point,
Right. Right.
right? Interesting. Interesting.
There may
Okay.
be some loopholes to that. I don't know if Magdiel was still on the call. We could ask him. There may be some loopholes to that. You know, maybe you can brand the apartments in a
Yeah,
certain
I
way.
have heard about like the amount of red tape kind of to get through that. Similar to like what is it called, the 40 what is that construction loan, like the
Okay.
FHA construction loan?
Yeah.
I
I know
can't
what
remember
you're
what it's
talking
called,
about.
203B or something like that. I can't remember what it is, but I heard those loans are good, but there's a lot of red tape too to
Yeah.
kind of go through on that side. They take longer to close. And I mean, do you think that is that kind of the maybe some of the same as well as these SBA loans take longer to close too?
Yeah, well, first of all, you're dealing with the government, and they're not the fastest entities out there. So just the
Yeah.
response time from, the underwriters is way slower.
Hmm.
Um, Also, they don't work, they kind of work in conjunction with the bank, but they're not the bank. They're a completely separate entity in the deal. And so, who's communicating with who's touching base with who? It's, as an agent, I want to know everybody's number. I want to call everyone, talk to everybody, make sure everybody's doing their job. And yeah, the guys over there in the SBA side of it, they move slower. They do have stricter criteria for those loans.
Hmm.
Um, but again, like I said, the important thing to know about it is it's an option that may help uh, businesses without options, or it's just another uh, revenue source or another funding source for investors to consider if they do it the right way.
Yeah.
The
Gotcha.
bit the the pros of it is the lower down payment generally,
Right.
10% or less in some cases.
Right. And that
Um,
longer payment period, repayment period,
yeah.
right? Magdiel was
So
talking, 10 years for the DSCR on the commercial
yeah,
side, but you're talking like up to 25 years, the SBA
correct.
loan.
You can
Yeah.
do that for 25 years uh, without a balloon. Um, Sometimes the interest rates are better. Sometimes they're
Hmm.
not. You can shop around, um, but again, versatility and having that option funding source is probably one of the most valuable sides of it as well.
Got it.
Um, the cons of the SBA, they're strict requirements. Um, you've got to prove that, with our case with the RV park, he had a pretty solid business plan, and they poked a lot of holes in it, and he revised it several times until they were happy with it. Um, and then man, it really does take a long time to
Mm-hmm.
close. 30 days is not an option with these types of loans. You're looking at 90 to 180 days.
Mm-hmm.
Um, and then every T's got to be crossed, every I. Is very significant documentation that they're going to require for those loans. So, um, and then of course it's not for investment properties, but obviously it is if they're allowing you to cash flow 49% of the asset, that is an investment. So it's just a method of commercial. I call it commercial house hacking. If you buy a
Mm-hmm.
duplex and live in one unit, and the other unit pays your rent, you know, it's kind of the commercial version of doing the same thing. So yeah, so that's that. We can talk more about that if that's something that people are interested in learning more. I think it's a great option. But just to review, because we're running out of time. And by the way, if you have questions or thoughts about anything, or if you want us to talk about hard money or private money, we can definitely hit that today. We got a couple minutes left, but we talked about hard money lending.
203K. Yeah, thanks, Javier. That's what I was talking about. The FHA 203K construction loan. That's the other one. Like I
The
think you
popular,
might be able to do that with commercial property too. So
yeah.
Yeah.
Javier is our go-to contractor. So if you need anything done from a new roof to a new foundation, call Javier. Javier, we need to get you as a guest on the show here soon. We're going to be talking about rehabs and stuff. I think next month we'll talk about that in just a second. But so we talked about hard money week 2 this month, and then last week we spoke about private money and opportunities there. Seller financing. I have a really good seller financing deal in Siena right now. If you're interested in a single family house in Siena with seller financing terms, message me 281-729-6604. And other things that we'll probably talk about in the future, we'll discuss syndication, crowdfunding, portfolio loans, HELOCs. We haven't talked about that. We can get Richard on the call. He knows a lot about HELOCs and using home equity. Edric knows about that too. So, any other last thoughts, Albert, or questions, or do we have any questions from Chad?
No, I mean, it was interesting to kind of hear. I've never really heard the commercial side of DSCR because I've always just been on the residential side of DSCR, and it's just a little bit more, some more requirements, obviously. I mean, and you're probably dealing with much larger loans, instead of your 2 or 3 or $400,000 DSCR loan or $500,000 DSCR loan, you're dealing with multi-million-dollar DSCR loans on the commercial side, potentially, right?
Yeah.
Yeah. And then I know people like if we get to that point of discussing syndications and things like that, you kind of have like these hybrids where you may syndicate like maybe the down payment, right? The down payment and holding and things like that for commercial property and use DSCR to actually purchase it.
Yep.
Yeah.
Absolutely.
So yeah, cool. No, it's
August.
yeah, lots of options, lots of options to consider.
We'll definitely continue discussing these. August, we're going to talk about this is going to be a great series next month. Rehab like a pro. We're going to have to get Javier on as a guest. We'll do our deal analysis next week. August 4th will be our deal analysis. And then August 11th, we're going to start budgeting, estimating rehab like a pro, how not to lose a bunch of money real fast. And then August 18th, we're going to talk about our relationship with our contractors, how to set those expectations, how to communicate our expectations. And then finally, we're in August with managing the rehab timeline, payment schedule. Should I have a GC? Should I have subs? Should I be the GC? How often do I check in with, how to do all that? So that's it.
Looking
I'm
forward to it,
Austin
man.
from Houston. Alberto, my brother, I appreciate you. Thank you, everyone, for being on the call. We will post this to YouTube and Facebook. And if you have a deal for us, no matter how crazy it is, send it
Let's
over.
talk about it.
We're gonna talk about it next week. All
Awesome.
right. Have a
All
great
right.
week. Thanks, guys.
Bye.